The candle range theory is the closest thing to the holy grail in ICT concept. What we need to understand about the candle range theory is that it is the understanding that every candle forms a given range within that period. We seek the liquidation of these range highs and lows. I'll be showing you guys how exactly to choose the correct CRT models and how to fully maximize the potential of this trading model. Now, throughout this video, you guys will learn about the three main models that I use specifically to trade the CRT model, as well as the correct way to enter this model, which would be the anatomy of the candle. From there on forth, I'll obviously give you guys the time frame combination that you can use as well as the specific times you want to be trading the CRT model. Now, for instance, if you're looking at this as a bullish candle, we'd fully understand that this is our low, this would be our high, this would be our opening of price, and then this would be our close of price. We could also be finding a lower time frame range from this. So if this is like the 3 a.m. 1 hour hourly candle, on the 5 minute time period, found that there'd be some sort of accumulation, manipulation, and distribution happening within this candle. That's why it's also very important to also understand the power of 3 model in confluence with the CRT model. And from this candle, you also understand that within this given time frame period, it would be from 3 a.m. to 4 a.m. Okay, that would contain the entire price action within that time period within this one candle. Okay, it's always good to remember that even though the candle range theory can be extremely powerful, it is another confluence that you are adding to your trading arsenal. As I said, guys, prerequisites for this video would be the turtle soup video that would allow you guys to understand the manipulative nature of this model, as well as the power of 3 and the AMD model. This model is not meant for isolation, okay guys? This little framework here shows you the sort of way you want to be trading the CRT model. Understand that this would be inside bar model where you would have your main candle, and then that will sort of contain, okay, all the price action that price could follow through from here, okay? But you'd be mainly focusing on the range high and the range low. Now, to fully maximize the potential of this model is to have in correlation a POI that price would then seek to tap into while also taking out a range high. From that point forward, you can understand that price is bouncing from here to go where a drawn liquidity, and that drawn liquidity would force price to actually take out the range low. So as you can see, right, you need to have your CRT model in a very good environment of a trade that is following your bias. So if this would be a bearish example, this would be what you'd be looking for. As you can see right here, this is an example right here. This would be your evening star candle range theory model. As you can see, this would be your first candle where price breaks above the range high, okay? We would expect price to distribute to the range low, okay? Because as I said, the CRT model, it is where price is seeking to take out the liquidations of both these range highs and lows. Yeah, we only took out the range high, but we did not seek the range low. That is because we started a higher intention for price to reach, which is this bearish order block where price then looked to take out this range low. That's why I said is want to be using it in good confluence, okay? And if you want to now draw the new candle range, it would then be this being your new candle range high, okay? This being your candle range low, seeing price make a quick purge of this high, tap into a bearish order block, and then now you're looking to come and trade back down into them, okay? This is actually one I've not seen anyone speak about really. I've sort of actually looked into and actually been testing this for quite a while now, and it's actually been going quite well because this is the tap and go. You won't always see those picture perfect examples where price always comes down to liquidate the range low and then go to the range high. Sometimes price will only minimally just open up, okay, and then tap the 50% of this candle, okay, and then look to target the range high. This works perfectly if you're in a extremely aggressive market. So if you are following a fully bullish market, I would advise you to also look for this model, because if it's having a volatility, it's very unlikely that price will find all the momentum to make a full-on reversal to take out the range low and then continue higher. Most probably price will just make a quick tap. This is what you sort of see on the lower time. Price opens up, accumulates, okay, manipulates to the 50% of that previous candle, and then distribute to the candle high, okay, leaving the candle range low untouched. If you guys even go to charts right now, you would probably see that if you're following a bullish market, right, the lows are being protected, which you would want to see in higher time frames. So this is why you won't always see that these candles can be used perfectly with the candle range theory. So which is why I also want you guys to now start to also implement the tap and go model for your CRT models. That is how you select the perfect model for the perfect scenario that you are in. As you can see right here, this is a nice example of this. We are on the daily time frame right here, and we can see price creates this daily candle right here, and we open up the day bearish, beautiful, but we only tap the 50%. We don't go all the way to tap down at the candle range low, but we are okay with that. We just understand this is going to be a tap and go model, which we can then use to target the previous daily high and still get our trade. Moving on from here, as you can see, beautiful stuff. This was the daily candle that distributed to the upside. We now had that reversal to the 50%, okay? And then as well as with this, we have our AMD model, the accumulation, the manipulation, and then the distribution, where you see that major volatility taking out that previous daily high, okay, our range high right over there. You'd want to now fully understand how the tap and go works. Candle price comes into the 50%, distributes high, okay? These are the two models that I would like you guys to focus on, okay? This would be the outside bar nature of it, where we have a stop and go, where I categorize this as simply price impulsing to the downside, okay? It then makes a retracement, okay? And then wicks above that now continues that impulse, okay? So it's a simple impulse, retracement, impulse model. Okay, now we move on to the next example, which would be the evening star pattern. Okay, where we start off with the first candle, okay, being a big chunky bullish candle. And now the reason that we want this to be a nice big chunky bullish candle, okay, full body minimal wick, is because what it does, it induces, okay, buys into the market. Good to understand that we can draw our range high and our range low above this point. Understand that this model works best when used with a POI. So we would see price pushing into some sort of bearish order block, wick rejected, and then we would then see price distribute to the downside. Me understanding, guys, that all these range highs, okay, is a turtle soup, okay, turtle soup of the high there, okay, as well as price also turtle souping this high and then moving to the downside. Okay, now as well, these are the two main CRT schematics as we just talked about, guys. The stop and go, this is how we wanted to sort of look on the lower time frame. Price making this a retracement back up, okay, where we'd have a short-term high, right? So this would be a short-term high. Price will come liquidate this point, create that turtle soup, and then look to go down and then go downward price, okay, following its long bias of bearishness. As well as with the stop and reverse, as I said, this has to be using confluence with a high time PD array with a target of a draw on liquidity. So price rallying to that PD array, okay, makes that pause in price, okay, causing you to see that low bearish candle, and then we see then price starts to distribute down lower to our draw on liquidity. The same thing there, guys. Just now, this would be on your high time frame. This is what we should be looking on for the low time frame. Now here's a nice example of this. As you can see right here, price very aggressively pushing to the upside. We see price just creating this little pause in price, and as you can see, we draw out this. If we focus mainly on this little candle over here, okay, we can draw out our range high and our range low. And as you can see, price, okay, slightly wicks below this point, but that's all we need. All we need is for price to wick below that point for us to find our turtle soup model and then be part of the new impulse in price where we see that go. Okay, you see right here on the lower time frame, drawing out our candle range low, drawing out our candle range high. Okay, you can see price makes the turtle soup of that low, minimally wicks it. Okay, makes a little change in state of delivery. But main thing I also want to draw your attention to is that I also have our little lower time frame CRT model here. You can see right here, here's our first candle, okay, where we can draw our candle range high, candle range low. Okay, candle range low. Our second candle, we sort of wicks below that low point. And then the third candle, where we look to see now price starting to actually rally to the upside, breaking about that candle range high. Okay, so you can see it's being used in fractality with each other. A very important note that I do also want to stress to you guys is that, especially with the candle 2, you want to make sure that usually in most cases that it does close within the candle range. So looking at this candle closes within this candle range. Okay, it didn't close above it, it closed in right inside. Okay, this does add a lot more probability to the price actually going in the intended direction to the range low. As you can see right here, this would be your stop and reverse model. As price is going aggressively, so you see now price is losing that volatility. It's starting to become a lot less aggressive. We're starting to see a lot more wicks. Okay, and there we go. We now see as price comes and taps into here, we see price purge the range high. Okay, and then we see it then target the range low. Obviously, wanting to use in confluence with some sort of drawn liquidity, we can see price fully coming down. So okay, this would now be on the lower time frame. You can see right here, price does make a few wick rejections into the high point. Okay, but we're mainly focusing on our candle range. So this will be our candle range high. Okay, candle range low, beautiful stuff. Price comes and taps into here, then gives us that little turtle soup above the high, and then we can come in and look to target at the fair value gap, looking to target low, okay, or even more high in price. But as I said, guys, always making sure with this model, with the stop and reverse, you have to have some sort of drawn liquidity that price is looking to target. Okay, you can't just use this in isolation. Now, as I say, guys, the CRT model is also used with other models that are familiar to ICT, one being the turtle soup and the other being the AMD model. As I showed you in the beginning with the anatomy of the candle, that the AMD model can form in an individual candle, but it can also form in 3 candles. So same example of the evening star right here. If you're drawing it out, this would be a perfect framework of how these candles would be forming on the low time frame. Very bullish in the beginning, then we start to trickle down, sort of create that accumulation. The next candle comes in, major wick. Okay, you can actually look at how the wicks are being formed here. The major wick means that there was a quick push up and then quick reversal down. Okay, and then a quick push back up. Okay, and then when I with the big chunky bearish candle, we can see that it was just straight bearishness. Okay, in that moment in price. Okay, this price falling down to the downside. So that's how you can sort of decipher how these candles are being formed, guys. If you guys just go onto your lower time and actually take the time to really investigate this model, you actually start to understand how these candles are being formed and how the price action are actually being played out. Okay, and then you can use that to really reinforce any other trades that you're looking to get into. So as you can see there, guys, beautiful AMD model there, forming out the understanding of the candle range high and our candle range low. This is a quick little lower time frame framework of it. As you can see right there, there was the first candle. Okay, so this would be our first candle right over here. So everything from here, okay, to right over here, we can sort of see this as our first candle, where we see that little push rally up, and then you can see price starts to trickle down, creating that accumulation, which we'd love to see. And then the second candle now coming in, quick sharp move to the upside with this major wick, just showing us quick 1-2, okay, a quick one too, and then this will sort of form the second candle. We see now price is just sort of making that quick reversal and then showing us our manipulation in price. And then obviously the big chunky little red candle would then be now your full-on retracement. I mean, would now be your full-on reversal where price now shows that full-on distribution to the downside. Okay guys, so range high was first liquidated and then range low was the last to get liquidated. This would be the perfect scenario for a bearish example using the AMD model in confluence with the candle range theory. You can also see it also format in two candles. This would be an outside bar little candlestick formation here, where we see the candle range high and low have already been taken out, okay? But you'd want to majority of the time be following the low, okay? So this wick right here would be where you want to look to enter, okay? Looking to then target that candle range high, okay? And as you can see right there, candle range low, candle range high, price manipulates the low, okay? And then it starts to distribute to the opposite, okay? Now the most important part that you guys are all looking forward to, it is how to enter a COT model. It's nothing crazy from what you've already known. It would be your normal tail swoop entry, okay? With the obvious chain instead of delivery, or you want to be a little bit fancy, you can be using the lower time frame CRT model as I've shown you previously, guys, looking to target the 50%, okay, for partially, okay, because 40% there, it is usually where price does look to hit it, okay? Obviously, you can leave the rest to run down to the range low, but I would say a safe bet is always to look to partial out at the 40%, okay, guys? Candle range, high, low, price sort of accumulates, manipulates, distributes, and you get your trade and you out the market. And now this would be an example that we did take this week on NASDAQ, so NQ, and as you can see, it's a perfect example of the CRT model being used in a valid based environment of different confluences. One of those confluences being the POI, the other one being that price is turtle swooping a major liquidation low. We now see the stop or slash pause in price. This is very important to us because now we can start to look for our CRT models. Rather than see a major big chunky bearish candle being formed out there, next second candle, major wick, third candle, we now start to see that price is continuing the rally. Stop and go. As you can see right here, this is on the lower time frame. Now with our entry, as you can see right here, so the second candle right over here, it formed that second wick, and then we look at the foregoing of the third candle being printed out. Nice little turtle swoop of the short-term low right over there. Nice entry into the old block, okay? And then obviously you target the range high, okay, guys? Nice and beautiful little simple trade there that we took this week on NASDAQ. As you can see right there, we're always aiming to part of the third candle because that's where you start to see that volatility kicking in. If you do want to get in a bit early, you can always look to get in at that change state of delivery. But I'd always say, guys, get your confirmation entry, especially if you've just started to use this model, okay? Now here's an example of us using the lower time CRT within a higher time CRT. So here we have our hourly candle. Price is creating this inside bar nature. All the price actually is being contained within here. As you can see, nothing is breaking the highs or lows, okay? But we are waiting for one of these highs to get broken or the low, and then we can trade to either direction. Right here, price breaks above the high and then distributes to at least the 50%. Right, they could have partial out and then fully come make a deep retracement, and then it finally comes to the full on hourly low, okay? And as you can see, this is what we see on the lower time frame. Range high, range low, price slowly comes to that area, okay? Now I look there, over there, we have our 3 candlestick formation of the CRT, big chunky candle, okay? Followed by a very tiny, nice and thin, indecisive candle, followed by that major distribution candle, okay? And then now obviously we look to just come into at that order block, looking to target the 50%, and we're out the mark, okay? Obviously price does come to the full on range low in the end. But you know, if you always want to come get your nice quick trade and be out the market, always look to target the 40%, guys, okay, of the hourly CRT or high time CRT model that you are using. Now, this is also a very good validation for your CRT models. It is the SMT. You see that NQ is creating this inside bar pattern. You'd want to go then check onto ES, see if ES is taking out the high. If ES is taking out the high, you want to be looking for sort of that low training state delivery pattern where you can now look to target the range low or at least the 40% of that high time CRT model, okay? And here are the liquidity levels that I want to stress to you guys. So this could actually be your higher time frame, you know, like your 4-hour candle right here, your range low, range high, okay? So we'll create it out like that, okay? And you have this inside bar pattern, price is just being contained within you, okay? Price is just being contained within this range, not breaking out either side. However, as you see, now price makes a major little wick below this point, and that's where you're looking to enter, okay? This wick point is where you're looking at your change state delivery, you're looking at price breaking above highs, looking to enter, okay? Then fully targeting that range high too, okay? As you can see right here, wick rejection point, price takes out, okay? Another wick rejection point, price takes out, another wick rejection point, price takes out. So all the lower wick rejections, they act as perfect liquidity points price to be using, so you can be using it for your CRT models to see them get purged, and then you target the opposite side. So if you come onto your trading day and you're looking to either trade, you know, your New York kills and your London kills, and you have these times in mind because you want to also be focusing on these specific time candles. So you go onto your hourly time to look at what the 3 AM candle is printing, what the 9 AM candle is printing, what the 10 AM candle is printing. Have these areas been purged, okay? If they have been purged, perfect. Look for other areas that are in conflict with this. Is there a bearish PD area that price is looking to tap into, okay? If there is there a draw on liquidity that price can look to target. Okay, then that's you finding your trade. That's how I would want you guys to be using the times with these CRT models. Lastly, I want you guys to also understand the basic time frame combination I'll be using with this. If you want to have the complexity on the low time frame, I'd always recommend going with the monthly and then going all the way down to the daily for your low time frame. The weekly having the 4 hour as your lower time frame, the daily linking up with the 1 hour, and the 4 hour in relation with the 5-minute time frame. Then obviously your 1 hour you want to be using in various scalping like positions. If it's your hourly candle, if you go into hourly time frame and you see your 3 a.m. candle, your 9 a.m. candle prints out, okay, this would be your range low, your range high. Price is creating some sort of PY that's right below this. Okay, you go down to your low time frame, look at what price is doing. Okay, 315, 330, 345, boom, we have that manipulation below the range low. We then look and see what price is then creating. 345, we now see that distribution to the upside. You look to enter and you target the range high. Okay, so that's the way that you guys are going to trade it. Literally the closest thing to the holy grail, because it follows the closest thing that we always look at on our chart, the candlesticks. Now if you guys want to learn a lot more specifically about the turtle swoop, I have made a video on that, so definitely go watch that out. It will give you a lot more validity to your CRT models. And make sure, as always guys, make sure to be part of the Discord in the description guys, where I will be posting guys live setups of this model in play. And also make sure to join up on the live stream where I'll be trading this CRT model with you guys live.